While airlines are struggling to make a profit, Westpac rolled out some big numbers with its half-year results. Net profit was up 38% to $4 billion. Like ANZ yesterday, Westpac was helped by a fall in bad debts. But with credit growth stalling and a loan book heavily skewed to mortgages, some analysts are wondering about future growth. Andrew Robertson reports.
Credit growth may have dramatically slowed, but for now, Westpac boss Gail Kelly is still smiling.
This is a good quality result, with all of our divisions delivering cash earnings growth and core earnings growth from the second half of 2010.
Helped by a tax benefit associated with its St George Bank subsidiary, Westpac lifted first-half net profit by nearly 40% to just under $4 billion. Other drivers of the result were a 47% reduction in impairment charges as the global financial crisis fades further into the background, and an attack on costs, which saw the cost-to-income ratio fall more than 1% to 41.2%. Interim dividend is up 17% to 76 cents a share.
The core business is basically tracking along at a reasonable rate given the current environment. It's good to see the bad and doubtful debt charge go down. The cost-to-income ratio went down, meaning lower expenses compared to the revenue, which is a little bit of a surprise, but that's the way Gail Kelly's been positioning her strategy in the bank since she's got there, and it's pleasing to see that come out probably a little bit sooner rather than later.
In a sign of the tougher operating environment for banks, net interest income fell 3% compared with the same period last year. Non-interest income was also down 3%, while core or underlying profit was down 4%. Gail Kelly, though, was not keen to make that comparison.
The traditional way of looking at results is year on year, so you're suggesting that we shouldn't be looking at your results comparing them to the first half last year.
We've given you full explanations on both, but if you want to look at trend, and your question was around trend and whether I was happy with the trend, if you're looking at trend, it's best to look at the at the most recent half. And on that trend, we're actually seeing revenue growth, we're seeing building momentum across all of our businesses.
Westpac's loan book has increased just 2% in the last 12 months, and its portfolio is heavily skewed towards home mortgages, where Gail Kelly is expecting another interest rate rise this year. However, she doesn't think that will hit Westpac's bottom line.
Expect to see increase in stress and more in the way of customers requiring assistance, customers requiring bridging to actually navigate their way through that, but we don't actually see it translating into loss.
BBY banking analyst Brett LeMessurier is not so sure, though. He says the outlook is very uncertain.
If the banking sector as a whole can still get of the order of 5 to 6% loan growth, then there should be enough of a decline in bad debts to make them a reasonable investment. But the key thing is what's going to happen to loan growth, and in particular what's going to happen to residential loan growth.
Brett LeMessurier adds that any decline in home lending could flow over into the already depressed business lending market, but Gail Kelly is tipping that business lending will start to recover by the end of the year.